question that we wanted to also cover the auditor's report draft format, because we received many inquiries from the members that they are also not sure about the audit report to be used. So what is to be done for audit report? So we have included audit report format in that. We also revised the financials to suit with these requirements of revised ICI classification, plus certain questions which are frequently asked where there is ignorance is there. So we have included FAQ also. So the publication on the non-company entities accounting standards, it is under finalization stage, and hopefully next week by this will be ready. And today at these junctions, my request to each one of you to please visit WSO or IC websites, and this is the right time for you to go through the model financials on non-corporate, which will definitely spare more time on this particular thing, which is the initiative for Vishalbhai, and it is really useful to all of you. At least just go through the financial statements. And if you have any suggestions, please feel free to be in touch with me or Vishalbhai, because we are in the stage right now to add and update. So something suggestion, something if you're looking for, we can definitely include in our publication. Now, as far as AS is concerned, that as you all are aware, the tax audit, where the limit of tax audit is increased beyond 10 crore rupees. GST audit, it has been removed as far as certification is concerned. Yesterday's GST Council meeting says that 9C is there, but it is self-certification. So same way, what will happen if you don't comply, if you don't perform or audit in accordance with the accounting standards, in accordance with the standards of auditing which are laid down, if without the quality, the tomorrow days are not far where anything which is under statutory will be go off. It may be a case where the small private limited companies audit maybe have not required. If you look at across world, there is no statutory requirements to audit. Even for companies, there is no statutory requirements. So tomorrow there is possibility where they can say that anyway, audit hua ki nahi hua doesn't make a difference. So why to have a more cost for anybody who is doing company? So same way, there is possibility that the statutory requirements of company audit, tax audit, and GST will all be out. However, what is critical for all of us is that we should have to ensure that our quality and branding should be intact. Because at various juncture, government is in a position and they want to tell to us that the quality of the tax audit reports, quality of the GST audit report which is being done is not up to the mark. So why anybody can come to so? I think that's why what is need for us is that we have to abide by the accounting standards and standards of auditing which is prescribed by ICI. That is the principle. That is the level which is expected for everybody to do it. One very important thing which I would like to highlight here is that accounting standard is not optional. It is compulsory. Even guidance note on tax audit issued by ICI, para 10.9, clearly mentions the fact that accounting standard has to be complied with it. So it is really important for all of us to ensure that this is not something it is optional given to you. The criteria which are revised by ICI, they are effective from 1st April 2020. So 2021 is the year where this is applicable. It is more relaxed. The number of companies to whom it is applicable has been relaxed, with the objective that we have to comply with it. See, relaxation is not with the objective that let us not do it. With the objective that what is been written, it has to be complied with it. And as I mentioned that there's a taxation audit quality review board of ICI, wherein the tax audit and GST audit report, it can be taken for the purpose of review. Just to look at the non-compliance and compliance of these particular requirements. So wherein it is critical for all of us that we have to ensure the notes on accounts, accounting policy, which is to be mentioned in the financial statements, are appropriately mentioned. So my compliments to both the branches for taking this initiative, because 2 days, I think for 2 days doing this session is wonderful. Majority of the branches are doing for 2 hours, which is very good. But however, you all have taken the initiative to do for 2 days, 2 hours, 4 hours sessions. I think that's what shows that how much you are really seeing that this is very critical, very important for the members. So my thanks to each one of you for being a part of this initiative of WRC to spread awareness on this. Any support if you require on seminars, faculties, accounting, auditing related, or any topics, you can approach to me, Vishalbhai, anybody in WRC. We all are here to support you. And my wishes to all of you for happy learning. And once again, thanks to both of you for giving me invitations and inviting me here. Thank you.
you, sir, for your kind
Thank you,
words.
sir.
Thank you very much, sir, for your kind words. It was very good to hear from you and also inviting us for openly having a talk with you whenever we feel like. Thank you very much, sir. Now, further, I would like to introduce Vishal Doshi, sir, who is a Vice Chairman of WRC of ICI for Baroda branch. We welcome you, sir. He further, I would like to introduce him. He's partner as Mrs. Praveen Doshi and Company Chartered Accountant Vadodara from 1997 to 2005. Then the firm was merged with KC Mehta and Company Chartered
Yeah,
Accountants.
Divya, sorry to interrupt. I think we can skip the introduction part
Okay.
because I was
Okay.
here a couple of weeks
No
back.
need of introduction, sir.
Okay, no problem, sir. But
Sir has
I would like to say that
Yeah, yeah.
heartily
yes,
we
yes.
welcome you, Amravati and Jalgaon branch heartily welcomes you for the session. Sir, please say a few words.
Yeah, yeah. Thanks, Divya. Sorry for to
No,
interrupt,
no
but
problem, sir. No problem.
uh, I always feel at home when I am at Amravati, Jalgaon, or for that matter, any branch of WRC. I would at the outset I would like to thank both the branches and especially the chairman Sunil Bhai and Prashant Bhai for giving me this opportunity to share my thoughts on the topic, which is I have always been a strong advocate with respect to the technical aspects of the accounting and the auditing part. And I'm also happy that I have with me Chintan Bhai, who is the chairman of the Ind AS and the Accounting Standards Committee at WRC. Uh, Friends, when we talk of accounting standards, somehow the non-company entities are the ones which are, I would say, neglected. Maybe because सामने जो क्लाइंट है वहां पे दे डोंट हैव अ प्रॉपर अकाउंटेंट या रिसोर्स जो सब ठीक से बना के दे. Second thing is that they are coming at the last minute, and if it's the last day to file the tax audit and the return, they would come 2 days before with the books and everything and dump everything at our office. तो हम लोग कभी सोचते हैं कि हम इसका ऑडिट कंप्लीट करें, टैक्स ऑडिट
Vishal bhai.
I think video.
Okay.
I think there
And
is some.
so I think this was a good initiative that Chintan Bhai has taken that, from at all the branches at the WRC, we must have at least one program on the accounting standards just to, I would say, brush up the knowledge of the members that these are some of the areas. And friends, क्या होता है कि हम लोग जब accounting standards for non-company की बात करते हैं तो this is typically where there is a requirement for an audit under the tax law. So typically, I would say the Income Tax Act. And therefore, what happens that we prepare the accounts as per income tax rather than as per the accounting standards, right? We keep that tax provisions in mind. Ultimately, ये balance sheet कौन use करने वाला है तो वो income tax वाले use करने वाले हैं. तो we prepare the accounts as per that, and due to that we oversee कि भाई अकाउंटिंग स्टैंडर्ड्स के क्या प्रोविजंस है, उसके क्या डिस्क्लोजर रिक्वायरमेंट्स है, क्या कंप्लायंस रिक्वायरमेंट्स है, that somehow we have a tendency to overlook that. And therefore it becomes very important to understand that first comes the accounting standards and then comes the tax. Or tax के लिए you have the ICDS, that if wherever there is a difference between the accounting standards and the income tax provisions, those adjustments have to be made through the ICDS. So that itself proves that for accounting standards, you have to prepare the financial statements as per the accounting standards and not as per the provisions of the Income Tax Act. The whole backdrop of having such webinars, अभी तो ऑनलाइन है इसलिए मैं वेबिनार बोल रहा हूँ, is that see अगर हम लोग अपनी खुद की ऑफिस में भी देखेंगे तो मे बी वी वुड फाइंड कि एक नॉन कंपनी एंटिटी की बैलेंस शीट और दूसरी नॉन कंपनी एंटिटी की बैलेंस शीट में भी हम लोग कंपेयर करेंगे तो वी वुड फाइंड मेनी डिफरेंसेस within the same office and the same partner or the proprietor signing two balance sheets. तो वी कैन इमेजिन कि अगर हम दो फर्म का कंपेयर करेंगे तो कितना डिविएशन आ सकता है. अगर हमारे फर्म में ही इतने डिविएशंस है तो आउटसाइड द फर्म कितना आ सकता है. And friends, let us understand that these financial statements ultimately, अभी तो क्या है, सब e-filing का जमाना आ गया है, so they are scanned and they are uploaded, right? With the tax of हम लोग जब return file करते हैं, the PL balance sheet with the audit report and everything is scanned and uploaded to the department. Now let us imagine that आप है जो ये सब आप study कर रहे हैं, you know, at the other side, on the regulatory side, and you find that the balance sheets and all, आप अगर 5 अलग balance sheet उठाएंगे, आप देखेंगे कहीं पे कुछ दिया है, कहीं पे कुछ और दिया है, कहीं पे comparative figure दिया है, नहीं दिया है. What is an impression that you carry as a regulator with respect to the audits that are being done by chartered accountants when it comes to the non-company entities? And so this has always been a gray area, because company की बात करें तो we have the schedule 3 where it is said कि आपको ऐसे ऐसे सब disclosure और format लेना है, disclosure करना है. When it comes to non-company तो ऐसा कुछ है नहीं, and then there is a free flow, सब अपने हिसाब से बनाते हैं. And the whole purpose of having such webinars is that for us within ourselves as a fraternity, we benchmark, we standardize, we upgrade the way we are reporting. कि आज सामने regulator की side से कोई भी balance sheet उठाता है, कोई भी firm की उठाता है, तो at least 80-90% they would have that consistency that has been reported. Let us say अगर disclosure of accounting policies है, तो all of us are aware कि कौन से client में कौन सी policies is mandatorily required to be disclosed, and all of us ensure कि हम लोग वो policy का disclosure करें. When it then comes to the format and the layout with respect to the financial statements, there also we have some standardization, some benchmarking कि हमको ऐसे ऐसे करना है. See, when you pick up, let us a listed company, I understand many of you would be investing in shares, और वो annual report वगैरह आते होंगे, या आप खुद भी as a chartered accountant research purposes के लिए you might be downloading. So you would find the format consistency and comparability is very easy from one company to the other company. So similarly, if we all come together, we all decide that we are going to standardize the format with respect to the non-company entities, with respect to the disclosures also, and with respect to the compliances also, then you can imagine that as a profession, as chartered accountants collectively, we are actually all working towards a much more higher benchmarking of our professional services that we are rendering towards the client. So, because see, as an extended arm, many of the non-corporate or non-company entities would have borrowings from bank, right? वो 50 करोड़ 60 करोड़ 100 करोड़ मैन्युफैक्चरिंग कंपनी है, टर्म लोन है, तो वहां पे भी हमारी बैलेंस शीट जाती है. So it's not just the income tax, but it would be going with the proposals that are there for any borrowings or to any other lending institution. So for all the stakeholders, if you ask me, it is very important that all of us realize the importance of following a particular format, following a particular benchmarking, and following certain minimum disclosure requirements with respect to policies and with respect to applicability of the accounting standards also. And once that goes out to the stakeholder, be it the lender, be it the regulator, be it anybody, the whole image of the profession, I assure you, आप बोले तो मैं स्टैम्प पेपर पे गारंटी करके देता हूं कि आज अगर if it is at this level and if we all follow this practice, it will definitely come up to this level. I can assure you, and that is how people would look, and there would be a very, very high respect and regards for our profession. And maybe going forward, considering that the seriousness with which we certify, we do our attest function, the government, instead of taking away the more attest services, because that confidence building has happened, that benchmarking has happened. And I believe, therefore,
Vishal sir?
Yes, connectivity issue is there, sir. I think, Sunil bhai.
Yes, yes.
Yeah, maybe connectivity issues there. He may be back. I think just wait for a couple seconds.
Yeah. आ गए sir. He is back. Yeah.
sorry, पता नहीं क्या हुआ. But yeah, so once again, I thank both the branches for giving me this opportunity to share my thoughts on this very important topic of accounting standards for non-corporate, non-company entities. Thank you. Back to you.
Thank you, Vishal sir, for your words and few things which you mentioned in your the sayings. Totally agree with you that importance should be increased for non-corporate entities also to make the financial statements comparable and easy. Thank you very much, sir. Further taking the session, I would like to introduce to our guest speaker, C.A. Shripal sir, who is the speaker for our today's session. He is Director of Audit and Assurance at KC Mehta and Company Chartered Accountants, Vadodara. He has experience in the said field of over 17 years. He specializes in conducting statutory audits of listed, unlisted, and other companies, including large public sector undertakings under Companies Act 2013 and IFRS regime. He is professionally qualified in DISA, course on India's forensic auditing and fraud detection. And he has special interest in IFRS, India's, and essays. Sir, we heartily welcome you, and Amravati branch and Jalgaon branch heartily welcomes you for the today's session. Over to you, sir. Shripal, sir.
Thank you, Divya. Good evening, everyone. Thank you, Sunilji, Prashantji, and entire team of Jalgaon and Amravati branch for inviting me and giving me an opportunity to present my thoughts and views on practical aspects related to accounting standards applicable to non-company entities. As Divya has succinctly said, that accounting standards are equally important for non-company entities. The reason being is that many of the non-company entities would be MSME. And as we know that MSME are the backbone of Indian economy. So the good qualitative financial reporting for non-company entities is a need of an hour and is called for. And that's why WRC has also uploaded on their website the model financial statements applicable to non-company entities. It is a masterpiece, and I would recommend every participant to browse through the WRC website and go through the model financial statements as well. Further to that, I would request active participation from all the members rather than only me speaking and making this session monologue and one-sided affair. I have prepared a presentation in a question answer format so that I solicit the active participation from all the members. I also had an opportunity to listen to an excellent presentation made yesterday by C.A. Chandrawali Thakkar, and she has covered some of the practical aspects on accounting standards. But the topic is such that one or two sessions would not be sufficient. So I would be covering some of the other important aspects and practical issues related to accounting standards. Let me share my screen.
Visible, sir.
Is it visible?
Yes, yes.
Okay. So I have divided my presentation into two segments. One is the conceptual issues that we come across in our day-to-day handling of our clients, and other is practical aspects of application of accounting standards. These conceptual issues, I would say these are core fundamental conceptual issues. I am sure almost all the members would be aware of those issues. But just to brush up our memories, I have highlighted 3-4 issues which we would discuss here. Hold on a second. Okay. The first one is a partnership firm has been preparing the financial statements disclosing current year's figures only. Whether comparative figures of immediately preceding year also need to be disclosed. So this is the question, and this is the basic fundamental question. What we have observed that many of the non-company entities only disclose the current year's financial figures, and comparative figures are they do not disclose the comparative year's financial figures. Whether it is mandatory, that comparative figures of immediately preceding year also needs to be disclosed. And another important aspect is if it is mandatory, under which accounting standard it has been made mandatory. So the answer would be yes, it is required. The comparative figures of immediately preceding year also needs to be disclosed. None of the accounting standard has stated that this is a requirement. However, if we go to the framework for preparation and presentation of financial statements, it clearly states that comparative figures need to be disclosed because users wish to compare the financial performance, financial position, cash flows for both the years and how the entity has fared in current financial year compared to previous financial year. So it is imperative that comparative financial figures also need to be given. Friends, a preface to accounting standards and framework for preparation and presentation of financial statements are as important as the accounting standards themselves. So these are adjacent to the accounting standards. So we cannot ignore a preface and framework for preparation presentation of financial statements while applying the accounting standard. So it is even more imperative that we go to preface and framework before we delve deep into the accounting standards. Okay. Coming to the second issue, which is also very, very apt and very relevant, an entity is covered in level 3 category. However, it has not disclosed that it is MSME in its financial statements. What are the implications? So as I said, I solicit active participation from the members. See, we are here to discuss and learn. So you can use your chat box or you can unmute and speak rather than me speaking and giving answers. And these are also probable answers which I thought are appropriate. There might be a contrary views on these aspects also. Okay, so since it has not disclosed that it is MSME in its financial statements, it might give an impression to the reader or to the user of the financial statements that all the accounting standards have been followed by this entity. Actually, in fact, it might not have followed all the accounting standards. A level 3 entity would have followed the accounting standards which are relevant and applicable to entity itself. But mere non-disclosure in the financial statement that it is MSME, it would give an impression that level 1 accounting standards are also voluntarily followed by level 3 category. Okay, third issue, an entity is availing presumptive taxation option under Income Tax Act while filing income tax return. Whereas it also maintains books of accounts and asks auditors to certify the books of accounts. Whether auditors should take into account the fact that the entity has availed presumptive taxation option while certifying and auditing books of accounts. It might so happen that entity would be filing income tax return under presumptive taxation regime, but it would also want to get its account audited. Say, for example, there is a partnership firm having 5 partners, and in order to lend a credibility to the financial statements and avoiding disputes between the partners at a later date, it might want to get its account audited, and it would come and ask us that please audit my books of accounts. Now, as an auditor, can I take a shelter under the guise that since the entity has opted for presumptive taxation option, then the compliance of accounting standards can take a backseat, and I can have a very lenient view as far as compliance to accounting standards are concerned. So this is basically a question, and this is very fundamental core question because many of the non-company clients that we deal with, they normally prepare the financial statements, as Vishal sir rightly pointed out, considering the tax aspects into mind. So this is very apt and relevant. What should be the answer to this aspect? So in my view, the answer would be absolutely and obviously no. Auditor cannot take a shelter whether an entity has taken a presumptive taxation option or no. Auditor has to verify the compliance of the accounting standards in toto, and if there is any deviation or departure in the accounting standard, then that needs to be brought out very explicitly in the form of modified or qualified opinion in audit report. Okay, these were some of the conceptual core issues that I have discussed. Now let's delve deep into the practical aspects as far as accounting standards are concerned. The first one relates to AS1, disclosure of accounting policies. So friends, here an entity has mentioned following accounting policy for revenue recognition in respect of goods sold. Revenue is recognized from sale on dispatch of goods, whether accounting policy is appropriate. Anyone, please? I think I don't have a luxury of going through the chat box.
Yes.
If any of the committee member can, access the chat box and inform me whether any answers are coming forth with.
Sure, sir.
Okay. Is this accounting policy is appropriate? That is the question. So answer would be clearly no, because significant accounting policies, what are significant accounting policies? Significant accounting policies are the core principles that have been followed by an entity to recognize and measure the amounts which are there in the financial statements. Okay, so significant accounting policy needs to be in sync with the requirements of accounting standards. And what accounting standard 9 states that revenue can be recognized only when the significant risk and rewards are transferred to the buyer. Okay, now here it is not clear that whether the dispatch of goods coincides with the transfer of risk and rewards or not. So in my view, this is an incomplete accounting policy. The entity should have elaborated further on this and stated that, okay, dispatch of goods is fine, but which is coinciding with the significant transfer of significant risk and rewards. So the answer would be no. Okay, second issue, an entity has mentioned following accounting policy for revenue recognition in respect of services rendered. Earlier question was on the recognition of goods sold. The second question is in respect of services rendered. It is mentioned that revenue from services is recognized as per the terms of contract, whether the accounting policy is appropriate. Sir, if you can, throw some light on it. Any member, no matter how incorrect the answer could be, that's perfectly fine. We are here to learn. So please participate and answer whatever comes to your mind. Anything, sir, from the team of Jalgaon or Amravati branch?
There is message from A. Vipul Patel, sir, Amravati. No, it should be as per AS.
Vipul bhai, you can.
Yes, I can access. Okay. Partially yes. Okay. Neela madam says partially yes. Okay. Okay, fine. In my view, this is a policy which is little misleading and obscuring. What are the terms of contracts? They have not been defined in the significant accounting policy, and whether the entity has followed the completed contract method for revenue recognition, or a percentage of completion of contract method, or some other milestone method on which it has recognized the services. We do not know what are the terms of the contract. So in my view, this accounting policy is little obscuring and incomplete. The entity should have further elaborated on the accounting policy. So answer would be no. It needs to be explicitly spelled out whether the entity has followed completed contract, percentage completion method, or some other basis like milestone achieved. Okay, on AS2, valuation of inventories. While valuing inventories, whether an entity has a blanket option to choose between FIFO, weighted average cost, or specific cost method. As we are aware that few methods have been prescribed under AS2. One of them is FIFO, weighted average cost, the other is specific cost method. So the question here is whether an entity can choose any of the method which has been mentioned in the question. Okay, one member has said yes, it has a blanket option to choose any method. I would say it would not be appropriate to choose any method. We need to look at the nature of the inventory. What inventories, what type of inventories the entity carries. If the inventory are such that they are not interchangeable with other inventories, or if the inventories are specific to a certain project, then specific cost method needs to be applied. And if the inventory is general in nature, which is ordinarily interchangeable, then an entity can choose either FIFO or weighted average cost.
Okay.
So the answer would be the items which are not interchangeable or which are specific to the project should be valued on specific cost basis. Other items which are general in nature, which are interchangeable, are to be valued either at FIFO or WAC basis, weighted average cost basis. Second question. An entity has normal manufacturing capacity of producing 100 tons of output. It has produced 80 tons during the year. The entity has been loading all manufacturing overheads based on 80 tons, that is on actual production basis, whether overhead loading is appropriate. See, friends, these are very recurring and oftenly encountered questions that we normally come across. And entities normally do not pay a required attention whether I am valuing my inventory on normal capacity or actual production basis. So as an auditor, this assumes a greater importance if we want to ensure the compliance with the accounting standard too. So one of the members has answered no, it's overvaluation of inventory. Okay. Agreed, completely agreed. So what AS2 states that variable production overheads can be allocated based on the actual production. And fixed production overheads always are allocated based on the normal capacity. So here, what is the normal capacity? 100 tons. What is the actual production? 80 tons. So variable production, the entity needs to identify what is my variable production overheads and what is my fixed production overheads. So the answer would be variable production would need to be allocated on the basis of actual production, whereas fixed production overheads needs to be allocated on the basis of normal capacity. Since one of the member has stated in the answer box that it is an overvaluation of inventory, let me flip this question. Say, for example, the normal manufacturing capacity is 100 tons, and the entity has stretched its normal capacity and produced 120 tons. Instead of 80 tons, it has produced 120 tons. So read this question accordingly. It has produced 120 tons. Still, a fixed production overheads would be measured and allocated based on the 100 tons, which is a normal capacity. So here in this case, the answer would be no. whenever entity produce higher than the normal capacity, then that higher production needs to be considered for the inventory valuation. So there is a difference between when the production is lower than the normal capacity and when the production is higher than the normal capacity. So we should bear this thing in mind. Okay, another question which is very pertinent, and many of the questions have been posed to us in this COVID scenario. While valuing inventory, whether NRV subsequent to reporting date needs to be considered. For example, NRV as at 31st March 21 is 30 rupees per kg. Cost is 35 per kg. So naturally, the NRV is lesser than the cost. NRV subsequent to reporting date is rupees 25 per kg. So subsequent to reporting date, NRV has gone further down from 30 rupees to 25 rupees. Now entity is valuing the inventory lying as of 31st March 21. Whether it should consider 30 rupees or it should consider 25 rupees. And if the answer is that, okay, NRV subsequent to reporting date needs to be considered, the one argument that might emerge out of this answer is that whether I am bringing onto the books future operating losses, because I have not sold my inventory, and whatever loss I would be incurring, that would be futuristic, that I would incur in the future period. As of date, I have sold my inventory on the 31st March 2021 at 30 rupees. Whatever inventory is lying as of 31st March, why can't I value based on the selling price which I have derived as of 31st March? So what could be the answer, appropriate answer to this question? So this is very pertinent question, and let me tell you, friends, this is not only relevant to a non-company entities. Many of the India's compliant entities are also, they were deliberating on this issue. So what could be the answer for this question, against this question?
Sir, we have to consider the events happening before signing of the audit report.
Let's take an example. If you have talked about the events occurring after the balance sheet date, let's take an example that COVID scenario is not there. I agree with you. Okay, due to a COVID pandemic, that was the condition. COVID was the condition that was existing on the balance sheet date. So what the AS5 states that the subsequent events, when we can treat that as an existing event, when there is a condition existing on the balance sheet date, then only that becomes an existing event, right? Now forget about the COVID scenario. We are talking about the normal circumstances now. Assume that there is no COVID, okay, and we are into a normal pre-COVID era, okay.
Okay.
Whether your answer would be different?
No, sir, it would have been the same.
Okay. Any other thoughts on this? This is one view. Yeah, one of the member has stated 25. They are concurring with your view. What should be the correct answer? Any other view? Give a good thought to it. Naturally, NRV is lesser than the cost, so there is no question of valuing the inventory at the cost. Now we need to choose between two NRVs, 30 rupees and 25 rupees. So basically the answer would be, we need to consider NRV subsequent to reporting date as well, because it gives an evidence of the carrying value of the inventory as of 31st March 21. EAC had an occasion to deal with this issue, and volume 2 of EAC opinion squarely and thoroughly deals with this issue, and they have also opined that NRV subsequent to reporting date before the approval of the financial statement by the partners or by the proprietor needs to be considered. So NRV of 25 rupees needs to be considered while valuing the inventory as of 31st March. Yes, so NRV till the date of approval of financial statement need to be considered. Volume 2 ESE opinion. Okay, moving further. AS10, property, plant and equipment. Normally what happens, non-company entities, they are disclosing PPE schedule on net basis. So whatever the closing WDV was there in the prior year's financial statement, they pick up that WDV and show it as a opening WDV in the current financial year and charge a depreciation. So there is no concept of gross value that is being followed. Accumulated depreciation is also not getting reflected. So whether the PP schedule needs to be disclosed at gross basis, this is the question. And what are the requirements of AS10? What does AS10 states on this particular issue? So answer would be yes, entity needs to disclose entire property, plant, equipment, and intangible assets as well. The entire schedule needs to be disclosed on gross basis. That is, a gross carrying value has to appear in the financial statements. Along with that, accumulated depreciation and current year's charge of depreciation has to be disclosed, and net block needs to be disclosed. Para 81 of AS10 clearly mentions that the PPE schedule needs to be disclosed on gross basis. So we need to be wary of this para, and if entities are following this method or disclosing the PPE on net basis, we need to recommend and highlight this issue to them and get this thing straight. Okay, the question is, but entity don't have a gross value details, how to deal with this? Very pertinent question. So what if the entity does not have a gross basis? So my view would be that backward procedures needs to be carried out by an entity and it can go back to the farthest extent possible. So let's take an example. In the year 2021, we have identified this issue and we want to correct this issue. Then we need to make a backward calculation to the extent possible. So let's take an example. I have arrived at a gross value which is available till the year 2018 only, 2018 only. And prior to that, information is not available. Okay, and we can easily determine the gross carrying value as of 2018, because if we go backwards, whatever depreciation has been charged, we can add back to the gross carrying value and arrive at the value. So we can begin with the 2018. We can take the 2018 value as a gross carrying value. Whatever depreciation has been charged in 2019, 2020, we can show it as a part of accumulated depreciation, and that can be taken care of accordingly. Though it is not very scientific and sacrosanct method, but accounting standards also permits, if it is impracticable to determine any value, then we can go backwards to the extent practicable only. So that is the leeway given by the accounting standards in general, not just a PPE in general. Yes, there is also a question, can we put appropriate note for the farthest period? And we must put a note. This is not a choice, but this is an absolute mandatory requirement. We must disclose appropriate facts based on which the gross carrying value and the accumulated depreciation has been arrived at. Moving ahead, a partnership firm contains a clause in partnership deed that the rates prescribed under Income Tax Act are to be adopted for depreciation purpose. and the firm is consistently following those depreciation rates, whether the same is appropriate. Anyone would like to try? See, there is a partnership deed, which is, for example, just take an example, it is registered with the registrar of firms. Okay. This is a binding contract between the partners. And partnership deed itself states that the depreciation rates are to be adopted, which are those have been prescribed under the Income Tax Act. And you are, as an auditor, auditing the financial statement of a partnership firm. What do we do in this scenario? Because most of the entities are following the income tax rates only. Okay, so just to ease the burden on themselves, and rather than, instead of preparing two PPE schedules, one for in compliance with the accounting standard and another for the income tax purpose, they have put this clause in the partnership deed itself that we would adopt these rates for the depreciation purpose. Now, as an auditor, how do we deal with this situation? So one of the members say it is absolutely appropriate. Any other thoughts on this question? I'm sure this question is ubiquitous and oftenly encountered by many of the professionals. So participants might be able to throw some light on it. Yes, this is appropriate. That's what one member states. Okay, two views have emerged. Both are in conformity with the accounting practice followed by the partnership firm. Any other thought or any contrary thought to it? Anyone? Let's be vocal. Okay, if we cannot, unmute ourselves and make a verbal communication, we might as well communicate through chat. No issues on that. But just give a probable solution to this question. I'm not saying that it has to be 100% accurate. Okay. So, okay. Let me put a poser to you. Whether the partnership deed or clauses that have been mentioned in the partnership deed override the requirement of the accounting standards. So no, in the partnership deed, I would say I would do anything. I would maintain books of accounts on a hybrid basis, whether we could allow it. In cash, I would book certain expenses on cash basis, and I would book certain expenses on mercantile basis. That has been prescribed in the partnership deed. Whether we would allow that. So basically, accounting standard provisions would prevail over the clauses of the partnership deed. And what accounting standard 10 states that a depreciation has to be charged based on the useful life of an asset. Okay, it might not be in sync with the rates that have been prescribed in the Income Tax Act. So it gives an incorrect impression when we mention that income tax rates have been adopted for the purpose of charging a depreciation. It gives an impression that the entity has not determined the useful life of an asset and blatantly taken the rates that have been prescribed income tax under the Income Tax Act. So answer would be clearly no. Depreciation should be charged based on the useful life of an asset, and deferred tax, if it is applicable. See, it may not be applicable to level 4 entities, but other level 1, level 2, level 3, if deferred tax is applicable, that would also undergo a change. Okay. So now what do we do in this scenario? Because we have been following this practice since years together now. And again, we go back to the PPE schedule gross basis question. We need to go back to the farthest extent possible and correct apply the correct depreciation method based on the useful life of an asset and recalculate the deferred tax accordingly. And we may also suggest an entity that this clause of the partnership deed, which is inconsistent with the requirement of AS 10, needs to be amended by way of an amendment of the entire partnership deed or by way of an addendum to the partnership deed. Okay. Okay. Another poser is an entity is still using fully depreciated asset and it further intends to use the same for next 3 years as well. What are the implications here? Say for like an entity has utilized the asset has been fully depreciated in the books and it continues to use that asset in its normal operations in the production of the goods or rendering of the services. And it wants to utilize the same for next 3 years. What are the implications of this thing? Normally, entities do not pay a required heed to this aspect. And what are the implications that I want to know from the members on this aspect? Whether it is okay, appropriate, that, okay, it has been fully depreciated or nothing has to be done now. So let it continue like the way it is being presented. An entity might as well use it for next 3 years. No problem in that. It's perfectly fine. Any other implications are emerging out of this question? That's what my basic question is. Members? Oh, sorry. Members, please respond. Anyone? Just give it a try. Okay. Let me, okay, if someone can tell me whether the depreciation is an estimate or not. Charge depreciation based on revised useful life. Okay. But what would be the carrying amount, sir? We need to disclose in notes. One member says we need to disclose in notes. Vipul Patel, Amravati branch. Yes, sir. You have said the charge depreciation based on revised useful life. But there is nothing to be charged on. The value of the asset is 0.
Sir, next answer must be right. Because it was from the expert.
These are very pertinent and relevant questions we often come across, right? So let me go to the basics, whether a depreciation or for that matter, useful life of an asset is estimate or not. Yes, all of us agree that it is an estimate. And what does the standard say? Estimate needs to be reviewed at least once annually. Am I correct? Okay, so in 2020, or for that matter in 2019, the entity has not reviewed the estimates for the useful life and for the depreciation that should be charged on the useful life on the particular asset. Is that true? Because standard states that estimates needs to be reviewed at least annually. So there was nothing to prevent an entity from reviewing the useful life of an asset in the year 2020. Okay. If it intends to use the asset for a longer period, they should have revised the useful life in the 2020 itself. I would say that this is an error in estimation of the useful life of an asset. We all agree that estimate, whenever there is a change in estimate, that change needs to be applied prospectively. But what about the error in estimation? Okay, let's take an example that we have shifted from straight line method to written down value method. That is not an error. That is a change in depreciation policy, depreciation method, and that needs to be followed prospectively. But in this particular case, what it signifies that the asset is fully depreciated and the entity is still using this asset. It intends to use it for another next 3 years. This is an error in estimation of useful life of an asset. Okay. What would be, let's see what is the answer. Estimate needs to be reviewed at least annually. This situation portrays that there was an error in estimating useful life. An entity needs to bring back 3 years carrying value by recalculating the depreciation charge. So again, we need to recalculate, go back, okay, and change the estimate itself when in the year 2020 itself, and bring back the carrying value for the 3 years. So basically, in nutshell, depreciation charge, say for example, the asset, the useful life that has been adopted by an entity is 10 years. Now the useful life is 13 years. So what would have been the depreciation charge had the useful life been considered for 13 years? Naturally, the depreciation charge for the respective prior years would have been much lower. That depreciation charge, which has been excessively charged in the profit and loss account, needs to be brought back and added back to the cost of a asset. And I would agree with the view of the Vipul Bhai that depreciation needs to be charged based on the revised useful life, and carrying value needs to be brought in the books accordingly. I hope I am clear on this issue. Okay, let's move to next issue. An entity has replaced the major part of its property, plant, and equipment. The cost of the part is rupees 10 lakhs. What should be the accounting treatment? Okay, many of the entities, this is a regular, normal feature phenomena that parts are being replaced by the entities. But whenever the major part is being replaced, then naturally the cost of that part can be considered for capitalization. Okay, so what would be the accounting treatment for this particular scenario? Again, I would repeat the question. The entity has replaced the major part. I'm putting the emphasis on the words major. Major part of its PPE. The cost of the plant is rupees 10 lakhs. What should be the accounting treatment? Okay, old part to be decapitalized and new part will be capitalized. One of the members states that, another says to be capitalized. Okay, fine. Any other thought on this? Derecognition of old part. One of the members says derecognition of old part and new part to be depreciated for balance period of plant. Okay. Any additional views on this issue? Okay, I would tend to agree with the views of some of the members that these the cost of the new plant needs to be capitalized, and the cost of the old part which is being replaced needs to be decapitalized. So we often tend to forget, an entity often tend to forget to decapitalize the carrying value of the old part that is replaced. So that needs to be taken care of. Okay, moving to AS11, the effects of changes in foreign exchange rates. One question that is pertinent here is, can an entity use bill of entry rate for import of goods and RBI rate for export of goods? Is there a violation under AS11? So here the entity is importing the goods and recognizing the import transaction at the rate which has been mentioned on the bill of entry. Okay, and whenever it exports the good, it just goes to the website of the RBI and the rate it picks up the rate from the RBI site and adopts that rate for the measurement of the export of goods. Whether it is appropriate and whether there is a violation under AS 11. So moot question is here that whether an entity can adopt two different rates for two different transactions. Import of goods is a separate transaction. Export of goods is another transaction, completely independent of the purchase. So is there any hindrance for an entity to use two different rates for two different transactions? Members, please answer. As I said, we don't want to make this session monologue. This should not be a one-sided effort. Committee members of Jalgaon Amravati branch, you can also throw some light on this issue. Okay. So basically, this should be a matter of accounting policy, actually. How an entity measures its foreign exchange transactions. So in my view, if bill of entry rate is used for import of goods, then bill of lading rate should be used for the export of goods. Why? What is the rationale? Because both the rates, bill of entry rate and bill of lading rate, are notified by one authority, that is custom authority. So we need to pick and choose the rate that has been prescribed by one authority. Either you choose a custom authority rate or you choose a RBI rate. But you cannot, pick and choose that, okay, for import of goods, I would pick a bill of entry rate, and for export of goods, I would pick RBI rate. That would portray incorrect picture as far as entities' foreign exchange transactions are concerned and its foreign exchange exposure is concerned. So whatever rate has been adopted, that has to be consistent and that has to be prescribed by single regulatory authority. Let's see what the answer is. Yes, this should be a matter of accounting policy for recognition of all foreign exchange transactions. If BOE rate is used for imports, of course, bill of lading needs to be considered because both rates are notified by same regulatory authority. Okay. Let's move to AS12, accounting for government grants. I would read this question, which is a bit longer in verbatim, just to lend a better understandability of this question. Okay, entity has been into existing since last 5 years and carry out various projects. In 2021, it has set up another new project which qualifies for government grant by way of a capital subsidy and reimbursement of certain qualifying expenses. The government also has acknowledged that the unit is eligible for the government grant by way of extending a letter of eligibility to an entity. Based on past experience, an entity is reasonably certain to receive both the grants, though with some deductions. The entity has already made an application to the government to release the grant with all the required documentation and supporting papers on 20th March 2021. So that is before the end of the financial year 2021. Therefore, the entity contends that the requirements of AS12 are complied with. The entity further puts forward its own arguments that there is a reasonable assurance of this grant and there is a reasonable certainty based on the past experience that the ultimate collection will be made. So these are the two basic pillars of the accounting standard 12 that there has to be a reasonable assurance of the receipt of the grant, and there has to be a reasonable certainty that the ultimate collection will be made. Whether these grants needs to be recognized in financial year 2021. So I would request the members to read this question again and understand the question in a proper perspective and come up with your probable answer. Say no, the grant cannot be recognized on receipt basis only. Okay. Any other view? Come on, members. Any probable solution. We are not here to prove anyone right or wrong, right? We are here to discuss, debate, and learn. So whatever, according to you, could be a probable answer, please mention in the chat box. I would wait for another 15-20 seconds. Okay, on receipt basis, one of the members has said, Prashantji has said that it needs to be recognized on receipt basis. Okay, another member has stated this as all conditions are fulfilled, then yes. Prashantji again says grant cannot be recognized in 2021. Why it cannot be recognized, Prashantji? Oh, you have just mentioned in the previous answer, it needs to be recognized on receipt basis. Is that what your answer is, Prashantji?
Because sir, it is the income partner. So we there is a reasonable uncertainty about it. So up to the time it is certain, we cannot recognize it.
What is the reason uncertainty here? Because prior experience of the entities shows that the reasonable certainty is there.
No, it's not necessary every time the same experience will be repeated, sir.
Okay, fair enough. Any other thoughts on this? Okay, so let's dwell what could be the various arguments. Okay, what AS12 says, whether AS12 says that the grant needs to be recognized on receipt basis only. I highly doubt it. I have not read that AS12 in any way states that the grant can be recognized on receipt basis only. So that goes out of the question. It can be recognized on accrual basis also. Okay. Wait a minute. One member has which certainty it can be recognized. Okay, that is it. So receipt basis accounting would not be appropriate for the recognition of the government grant. That is one thing. Okay. Now another thing. Let's come to a reasonable certainty part. The prior experience of entity has demonstrated without doubt that there is a lack of reasonable certainty here. Okay. So basically, as Chandrawali Thakkar has rightly pointed out in her presentation yesterday, there are 4 pillars of the accounting standards. One is recognition, another is measurement, third is presentation, and fourth is disclosure. All these 4 pillars are equally important. So recognition criteria in this case is perfectly met. Okay. Company is reasonably certain it has a prior experience. It has submitted all the applications. Okay. There are no additional conditions attached to the receipt of this grant. It has already executed the project, already incurred the expenses. Okay. Now what is there which is preventing an entity not to recognize this grant in 2021. So all of us, I hope, agreed that recognition criteria is met. Now let's come to another pillar, whether measurement criteria is met or not. Say AS9 is not applicable to AS12 accounting for government grants. So there could be an argument that since AS9 does not apply, the principles of AS9 would also not apply to the recognition of government grants. We don't have to go to the extent of measuring whether there is a measurable amount is there or not. Okay. AS12, though discards the recognition criteria which have been prescribed under AS9, but the principles of AS9 for the measurement of the government grant would still apply. And we need to consider the requirements of AS9, whether a measurement can be estimated reliably or not. So here the question, it has been mentioned in the question, the entity is reasonably certain to receive both the grants, though with some deductions. This is very important, though with some deductions. So there is a measurement uncertainty. If I want to recognize the grant, at which amount I would recognize, any amount which I would take would be misleading. I'm not sure the quantum of the government grant that I would be receiving. So recognition is there, but the measurement criteria fails here. So when the measurement criteria fails, the entire recognition criteria also gets defeated. So unless and until this measurement uncertainty gets resolved, the entity cannot recognize these government grants. So basically in 2021, this grant cannot be recognized. There may be a situation where before the approval of the financial statements, these uncertainty can get resolved. Say for example, entity has put up an application for releasing the grant of 1 crore rupees. Okay, now in the month of May, before the finalization of the accounts, the entity has received the grant of 80 lakh rupees. So the measurement uncertainty gets resolved in the month of the May, whether that needs to be treated as adjusting event or not. My answer would be yes. The entity can recognize a grant to the extent of 80 lakh rupees in the 2021, because what subsequent events state that you cannot treat any event as an adjusting event if the recognition criteria was not met in the year 2021. It does not state that you cannot adjust the particular event for the measurement criteria also. So, for example, a sales that we are making, and if the significant risk and rewards are not transferred to the buyer as of 31st March 2021, we just reverse those sales, though it would have been accepted after the subsequent, after the reporting date. Okay, why we are not recognizing that sales in the 2021 itself? Because it has failed the recognition criteria in the first instance itself. So there are two concepts, recognition as well as measurement. So in government grant, recognition criteria was always met in 2021, but because of sheer of lack of measurement certainty, this grant is deferred to a later date. Hope I am clear. The answer would be no, measurement uncertainty exists. Though AS9 does not apply to the government grants, the principles enunciated therein would still apply. Okay, let's come to AS13, accounting for investments. An entity has been making investment in shares and also holding shares as stock in trade. The entity has disclosed all shares under the head investments. whether such classification is correct. Okay, the shares investment has been made, and there have been few scripts which has been held as stock in trade. The entity has put the entire basket of shares under the head investment. Whether such classification is correct as per AS 30. Anyone? So Mr. Satish Patel has given an answer. Generally, if there is a minor deduction by experience, then why such grant should not be recognized? Okay, the measurement, see, I have already mentioned, if subsequent to reporting date, if the measurement uncertainty gets resolved, then recognition can be made. But if the minor deduction, whether I am certain whether there would be minor deduction or not. So there is a reasonable uncertainty existing as on the base, reporting date. There is nothing like a virtual certainty in this case. So reasonable uncertainty is a higher level of uncertainty which needs to be satisfied in order to recognize the government grant. Okay. So coming to the AS 13, accounting for investments. Okay. One member has stated that no, this classification is incorrect. Another member has said no, trading in shares shall be shown under the inventory. Okay. Prashantji says no, this is incorrect classification. So I would agree with the views of the member. This classification is incorrect, and whatever shares that have been held as stock in trade, those needs to be shown under the head inventories and not under the head investments. Further to that, how this needs to be valued. Okay, we have put these investments under the basket of inventories. How this needs to be valued? So the quick answer that comes to mind is that since it has been put under the head inventory, the valuation norms that have been prescribed under AS2 would apply, right? Am I correct? So AS2 would apply in valuation of the inventories and valuing the shares as held for stock in trade. So basically the answer would be agreed. This needs to be, the shares which are held as stock in trade needs to be shown as inventories. But the valuation norms, those have been prescribed under AS 13 would need to apply to the shares which are held as stock in trade. So there is there is a deviation from the AS2 also here. AS2, for the classification, AS2 would apply, but for the valuation purpose, we need to refer AS13, and AS13 contains a para of valuing the current investments. And what does it states that current investment need to be valued at lower of fair value or cost. Okay. So fair value concept also comes into the picture for the valuation of inventory also, for the purpose of valuing the shares as held as stock in trade. So answer would be, it should be shown as inventory. However, accounting treatment related to investment as prescribed under AS 13 would still apply. And as I said, fair value or cost needs to be considered for valuing such shares. Moving ahead, the current investments were acquired at a cost of rupees 10 lakhs, whereas the fair value as on balance sheet date is 12 lakhs. Due to insufficiency of profits from regular operations, the entity would like to recognize the profit on these investments, whether it can recognize such profit. So here is the question is that there is a current investment which has been acquired at rupees 10 lakhs and the fair value as on the balance sheet date is 12 lakhs. Due to insufficiency of profits from regular operations, the entity would like to recognize the profit on these investments. Okay, one of the members says no, another member says no. Why not? Please give rationale in the chat box. Why not? Entity is suffering from the, it has not been able to report the sufficient profit. And since the fair value as on the balance sheet date has increased, it might as well book the gain on this investment. What is wrong in it? Because here the profit is not realized. Okay, another member says that current investment to be recognized cost or fair value, whichever is lower. Maybe in future the prices may go down. Yes, very fair argument. So members, here it is not the question whether the profit has been realized or not. Say for example, say the fair value is 8 lakh rupees. Then it needs to be recognized as fair value. I agree with you that AS1 states that the notional gains need not be recognized. Agreed. But here in this case, the current and investments needs to be recognized at cost of rupees 10 lakhs only. It cannot bring back or bring onto the books additional profit of 2 lakhs because the standard itself states that current investment needs to be measured at lower of cost or fair value. Okay. Now, say for example, here, if I may add one sentence to this question, fair value as on balance sheet date is 12 lakh and market value is, say for example, 9 lakh rupees. Then what? Say AS13 mentions two different concepts. One concept is fair value, another concept is market value. Normally, we do not find any difference between the fair value and the market value. But AS13 has specifically categorized two different concepts in the standard itself, fair value and market value. Say, for example, market value is 9 lakhs. I would come back in a minute what is the difference between the fair value and market value. But say, for example, for the time being that market value is 9 lakh rupees, which is again lower than the cost of 10 lakh rupees. Whether I would recognize a loss of 1 lakh rupees. Lower of 2, yes. Mr. Satish says lower of 2. Chandali says yes. Prashantji says yes. Okay, Prashantji also concurs with the view of other participants that lower of 2 needs to be considered. Mr. Jain said yes, 9 lakh rupees, so 1 lakh needs to be recognized. Okay. Okay. So basically, what is the difference between the fair value and market value? Let me come to that distinction first. If we remove selling cost from the fair value, that becomes my market value as per AS13. Say for example, my fair value is 100 rupees. And if I am going to incur 10 rupees as my selling cost, brokerage charges, another few transfer charges, say I am going to incur 10 rupees and I am going to fetch 90 rupees. According to AS13, that 90 rupees is my market value. So net selling price as prescribed under AS2 would be my market value under AS13. Hope I am clear about this distinction. And some of the members have stated that since my market value has gone down below cost, I need to recognize 1 lakh rupees as a loss on the current investment. Friends, we entity cannot recognize 1 lakh rupees as a loss on the investment. Again, I'm going back to the measurement of the current investment. What does it state? It states that current investments needs to be measured lower of fair value or cost. It does not state that lower of market value or cost. So even if I'm going to incur loss or market value is lower than the cost, I need to value my investments at lower of fair value or cost and not market value. Hope I'm clear. Okay, lower of cost or FV. FV is different from market value. Coming to AS15. Okay. An entity is having only 2 employees. This is the first year of employment, and it does not intend to make provision for retirement benefits. Whether this would be treated as departure from of AS15 requirement. Entity is just having 2 employees, and this is first year, and it does not want to create a provision for retirement benefits. Okay, let me put the question in a different manner. Since the retirement benefit here in this case, I'm talking about the gratuity benefits. Whether the gratuity benefit needs to be recognized from day one, or because the obligation of the gratuity would come into picture after the employee completes the 5 years of service. So why should whether I am required to measure the gratuity liability from the day one of the employment, I can wait till the end of the 5th year. So basically, though my obligation to pay the gratuity arises after the completion of 5 years, provided the employee leaves the services. But whenever I pay the gratuity benefits, I'm not paying those benefits for the 5th year alone. I am paying those benefits for the 1st, 2nd, 3rd, 4th, and 5th year. So the entire liability of the gratuity would accrue from the day one. So as and when the employee renders the services, I would build on my liability towards the retirement benefits. So it would be prudent and imperative to recognize the gratuity liability from the day one of an employment. Yes, Neela ma'am says day one and not to wait till completion of it's accrued from day one. Absolutely correct. Now coming to the question, the entity is having only 2 employees, and this is the first year of employment. And if entity doesn't want to make a provision, whether it would be appropriate. Members, please respond. I request for your active participation. Please do so. Okay, Neela ma'am says technically no. No means what? I mean, it would not be treated as departure from AS15 requirement. That's what you are trying to say, ma'am? What happens if employee leaves before 5 years? Okay. Yes, departure from AS15. Okay. Okay, Sunilji, just to answer your question, if the employee leaves before 5 years, the entire provision that has been recognized would get reversed. But it does not exonerate an entity from not recognizing the benefit liability from the day one. So liability would accrue from the day one. Okay. Okay. So here the question comes whether my liability would be material or non-material. That is the fundamental question that we need to see, whether the liability would be material or non-material. Say, accounting standard framework states that all the accounting standards, not the AS15, all the accounting standards would apply to the items which are material to the presentation of the financial statements. So we need to work out whether the liability is material or not. If it is material, we do not know, Neela ma'am, right now whether it is material or not. We need to ask to an entity to work out based on the rational and consistent method. As there has been exemption given for entity employing less than 50 from the actual valuation, we can as well follow the another rational method. We can take provisions of the Gratuity Act into a consideration and work out what would be the liability. If the liability comes to a material level, then it needs to be recognized in the financial statements. And of course, in first year with 2 employees, it might be material, but when there are no operations in the entity, the materiality level for the auditing purpose would be too low. And whatever expenses are there, including the gratuity expenses, might become material also. So we need to ask entity. We don't have to, compute the entire thing on our own. We need to ask entity to calculate what would be the probable liability that would emerge. Okay. And if the liability is material, that needs to be recognized. And if not recognized, an auditor might consider qualifying its audit report. Okay, AS framework, AS applies to items which are material. If amount is material in the overall context of AFS and provision is not made, audit report needs to be qualified. Again, one peculiar issue that is emerging for the entities employing more than 50 employees. What the standard says, how to measure the defined benefit obligations, DBO as we call it. What does standard says? Actual valuation should be carried out with sufficient regularity and at minimum at an interval not exceeding 3 years. So basically what standard states that entity need not go for an actual valuation every single year. It can choose to value its defined benefit obligation once in 3 years. But if it chooses so and has not carried out actual valuation, the standard states that what the entity has to do, that most recent valuation report is updated to reflect material transactions and other material changes in circumstances. Now, how to deal with this requirement of AS15? On one hand, it says that actual valuation need not be required to be carried out annually. It can be carried out at least once in 3 years. And it again states that say, for example, in 2019, the actual valuation has been carried out and company does not want to carry out the actual valuation in 2020 and 2021 as well. What does standard says that 2019 actual valuation report needs to be updated with material transactions and other material changes. Now, practically speaking, is there any exemption given by a standard? Because see, the measurement of defined benefit obligation is so complex. It involves so many estimates, so many assumptions, so many financial models are there. Black and Scholes model are there. Binomial model is there. Are we competent? Or for that matter, is the entity competent enough to update the recent valuation report? Or for that matter, say, for example, some random figure has been put forward to us as an auditor. are we competent enough to verify the authenticity or veracity of those figures? Because we are not technically experts in this field. Okay. So no matter how much efforts the entity puts in or how much efforts we put in, whatever audit evidence we would gather from updation of this recent valuation report would be less than conclusive, in my view. So we should invariably insist on obtaining the actuarial valuation by the independent actuary only. Otherwise, what it would mean, that it would tantamount to us stepping into the shoes of independent expert, which we ourselves are not competent enough. So we need to be wary of this thing where we want to avail the exemption that has been given by the standard. I hope I am clear on this aspect.
Yes, sir. There is another question from a member. What happened if employee leaves before 5 years?
Generally, a note is given that gratuity would be accounted on cash basis. Is it correct? Absolutely not, sir. A cash basis of accounting is not permissible unless the entity adopts a cash system of accounting. And normally, cash system of accounting is permissible for few selected professionals. Say let me put it in a proper perspective, that accounting standard states that the accounting, all the entities needs to follow accrual system of accounting. Okay. And if it is not followed, a fact needs to be disclosed. Nowhere it states that which entity is qualified to follow cash system of accounting and which entity is qualified to follow accrual system of accounting. So when the accounting standards themselves do not give enough guidance, we need to go to other regulations in order to see that whether those regulations allow a cash system of accounting. So in this case, we need to go to income tax provisions. And income tax provisions allow only few selected professionals and some businesses where the cash system of accounting is allowed. For other businesses, only mercantile system of accounting is needs to be followed without any deviation. So in my view, the gratuity, if it is accounted on cash basis, would be a departure from the AS 15 requirement. And as an auditor, we need to qualify our report.
And sir, there is one more question, that what happened if employee leaves before 5 years? Like we have following the actual basis of accounting, but if that employee leaves before 5 years, then what would be the treatment?
I think I have answered that question, that whenever employee leaves before 5 years, see, actuarial valuation report contains some of the judgments, okay, that how many employees would be expected to leave their organization. And based on those judgments, the actuarial liability is determined. So that fact is already factored into the actuarial valuation report. Okay. And if an employee leaves an organization before 5 years, the gratuity liability related to that specific employee needs to be reversed straight away.
Okay. Got it, sir.
Yeah. AS 16, borrowing cost. Okay. Entity has borrowed funds to set up project. The project is ready for use on 1st October 20. It has been put to use on 31st March 21. The entity has capitalized borrowing cost incurred till 31st March 21. Whether the same is appropriate. No. Chandravali says no. Any other member? Yes, one of the members say yes, the entity has capitalized borrowing cost till 31st March 21 is absolutely appropriate. Prasanji says yes. Okay, Pratik says no. So there is a divided house. All borrowing costs till asset put to use should be capitalized. Vipulji says yes, all borrowing costs till asset put to use should be capitalized. Okay, I appreciate the participation from the members, but I want more views on this issue. Sunil say no. Yes, fair enough. Okay, let's move. Yes, as it is put to use after 31st, it can be capitalized. Chandravali says asset is ready for use from October. Okay. Okay. So let's see what A16 requirement is. A16 states that when substantially all the activities for the intended use of an asset are complete, the borrowing costs cease to get capitalized. So it doesn't qualify to be capitalized after all the activities. Substantially all the activities are complete. So here in our case, the project is ready for use on 1st October itself. That means the substantially all the activities were ready and the project was in fact ready for its intended use on 1st October 2020. So borrowing costs should cease to be capitalized from 1st October 2020 itself. Entity cannot recognize the asset borrowing cost till 31st March 2021 because the actual put to use date is not relevant here. Let's see what answer is. No, cessation of borrowing cost would apply. Substantially all activities for assets intended use are complete. Actual put to use date is not relevant. Okay. Moving to next question, whether the amount of borrowing cost capitalized during the period needs to be disclosed in the financial statements. So let me tell you, friends, many of the entities falters on this disclosure. Okay. Yes, according to AS16, capitalized borrowing cost needs to be disclosed in the financial statements along with the quantum of amount that has been capitalized. So this is the requirement of AS16 and this needs to be disclosed appropriately. We can put this as a footnote to a PPE schedule as well, but somewhere it has to be disclosed. Okay, this is kind of a tricky question that I have come across. The nature of some of the inventories could be such that they take substantial time to be ready for intended use. For example, wine. Of course, this is not a very good example that to be given, but let's take an example. Okay, wine needs to be matured for longer period and it forms part of the inventory. Whether borrowing costs can be capitalized on such inventories. Sunilji says yes. Is this relevant to this question, Sunilji? Okay. Yes. Another member say yes, it can be capitalized. But when we go back and read the relevant para of AS2, it states that the borrowing cost are usually considered not related to bringing the inventory to present location and condition. So normally the borrowing costs are excluded. Okay, so the answer would be yes, whenever circumstances and facts are such that borrowing costs can be capitalized on the inventory, it can be capitalized. What AS2 says that Para 12 of AS2 states that borrowing costs are usually considered not relating to bringing the inventory to the present location and condition. The word usually is very relevant here. It does not completely debar an entity from not recognizing the borrowing cost. It says usually it is not recognized, but there are facts and circumstances which warrants capitalization of borrowing costs onto inventory. It can still be considered so. AS16, again, an entity is implementing a project costing rupees 10 crores. It has borrowed rupees 7 crores from bank on 1/4/19 at the rate of 10% per annum. On account of prevalence of COVID-19 pandemic, the construction of the projects was halted for 6 months. Whether the interest expenses incurred during these 6 months are eligible for capitalization. No suspension will be there. Chandrali says no suspension will be there. Any other views? Members, any other views on this? So these are basic questions which we would face when we finalize the accounts for 2021 as well, because COVID situation and lockdown in many cities are still prevalent. Mr. Jain says, yes, it can be capitalized. Yes, if other planning activities were ongoing. Pratik says if other planning activities were ongoing. So I tend to agree partially with what one of the members has mentioned, that suspension needs to be considered. Okay, Mr. Jain says since construction is in progress. Thus the question itself, Jain sir says that it has been halted for 6 months. Okay, let's go to an answer. So what does A16 states that whenever there is a suspension of active development of a project, then during that suspended period, the interest cost do not qualify to get capitalized unless there are other activities which are going on, like say for example planning, researching further things, designing, or some sort of things which can be taken up off-site, then those activities needs to be considered. So if the active planning and development is there, though the construction is halted, then the interest cost still qualify to be capitalized on the cost of the asset. But if the entire construction, all the activities are halted for 6 months, then the cessation of or suspension would apply and the interest cost would cease to be capitalized. Cost needs to be suspended during the extended period in which active development is interrupted. Okay, the entity had obtained the following borrowings on 1/4/2020 for capital expansion. So these are the borrowings that have been obtained by the entity. The entity is constructing 3 plants, A, B, C. Cost of the asset is 100, 125, 175 respectively. And in remark, it has been stated that for plant A, there is no specific borrowing. For plant B, Bank loan of 65 lakhs is obtained at the rate of 10%. For Plant C, 175 is the cost of an asset. 9% debentures of 125 lakhs has been obtained. So friends, here we can observe that for Plant B, though the cost of an asset is 125, bank loan is just for 65 lakh rupees. And for Plant C also, cost of an asset is 175 and debentures are for 125. In addition to the above specific borrowings, the entity had obtained term loans from two banks. Please pardon the typo error. It has been mentioned from. It should be read as from two banks. Rupees 100 lakhs at 10% from Bank of Baroda. Rupees 110 lakhs. 100 lakhs has been remained to be mentioned here at 11.5% from Canara Bank. Both these loans have been obtained by an entity on 1/4/2020 to meet its capital expansion requirements. Please mark these words, capital expansion requirements. What is the amount of borrowing cost to be capitalized in each of the above plants? Assume all plants are qualifying assets and are under construction as of 31st March 2021. So here is the case of specific borrowing and general borrowing as well. So how do we deal with the situation here? That we need to compute the weighted average capitalization rate for general borrowing. Now, what is the general borrowing is here? Say for Bank of Baroda, 100 lakhs is general borrowing. For Canara Bank, 110 lakhs is the general borrowing. And 10% is the interest rate for the Bank of Baroda and 11.5 for Canara Bank. And interest for the year 2021 would be total would be 22.65. Why it has been treated as a general borrowing? Because it has been for a general capital expansion requirements of an entity. So it is a general borrowing for the capex plan as a whole. So total interest expense that comes to is 22.65. If we find out the rate 22.65 divided by 210, which comes to 10.79. That is the average capitalization interest rate for the general borrowing. Now, capitalization of borrowing costs under AS 16 would be as under. So for the general borrowing, we know that 10.79% is the general borrowing that we have arrived. For the specific borrowing, the rate has already been given as if we recall, that 65 lakhs is the specific borrowing for Plant B and 125 lakhs is for Plant C. So for B, specific borrowing is 65 and for C is 125. And for specific borrowing, the rate of the interest is given. So for general borrowing, 10.79%, and for specific borrowing, a specific rate has been considered. So basically, interest amount that needs to be capitalized comes to 40.40 lakh rupees. That needs to be capitalized. So general borrowing as well as possible specific borrowing needs to be considered for capitalization. AS 18 related party transactions. An entity is engaged into the business of rendering project consultancy services. It has rendered such services to one of its related entities. However, no fees have been charged by entity and accordingly, this transaction is not given accounting recognition. Would this constitute related party transaction requiring disclosure under AS 18? Of course, this would be relevant to not relevant to level 4 entity or if I remember correctly, level 3 entity as well. But level 1 and level 2 entity, AS 18 disclosure would be mandatory to be given in the financial statements. So here is in this case, the entity has been rendering the project consultancy services and it has rendered such services to one of the related parties free of charge. So there is nothing to be recognized in the financial statements. And so whether these would constitute related party transaction requiring disclosure under AS 18? Here the term disclosure is very important What would be the correct thing here? Yes, Mr. Jain says disclosure is still required. Okay, fair enough. What could be the other argument? Okay, let's move. Okay, I tend to agree with Mr. Jain's view. These would constitute related party transactions requiring disclosure. AS 18 states that the related party transaction is a transfer of resources or other economic benefits. Whether price is charged or not charged is irrelevant. Okay, so let's go to the answer. Yes, this constitutes related party transaction requiring disclosure. As per AS 18, a related party transaction is a transfer of resources or obligations between related parties, regardless of whether or not a price is being charged. So here we need to mention this is a related party, the name of the party. And we need to mention that this transaction has been carried out or no fees has been charged. That fact has to be mentioned in the related party disclosure. Coming to AS 19 leases, a lease agreement to use an asset is for 3 years. The agreed rent payments are first year it is 1 lakh, second year is 1.4 lakhs, third year is 1.8 lakhs. An entity has recognized rupees 1 lakh as rent expenses in the financial statement of first year, whether the accounting treatment is correct. The entity has paid 1 lakh rupees in the first year and incurred 1 lakh expenses as a rent expense in the first year. And the same has been charged off as a rent expense in the financial statements of the first year. Whether the accounting treatment is correct or whether the recognition of rent expense in the financial statement is correct. Anyone would like to try? Okay, what AS 19 states that whenever there is a fixed term of lease, here in this case is 3 years, and when there is an escalation clause in the lease deed, then the lease rentals needs to be straight line. The lease rentals needs to be recognized on the straight line basis. So in this case, what is the total obligation of, on the entity against these rentals? 1 plus 4 plus 1.8. Okay, that entire amount needs to be straight line, and whatever charge comes in the first year needs to be recognized. So basically accounting treatment is not correct. Entity has to recognize lease rentals on a straight line basis unless the lease period is 12 months or below. The entity should have recognized rupees 1.4 lakhs in the first year itself. This is the fundamental concept that has been prescribed under AS 19, straight lining of the lease rentals. Okay, coming to a next question. A lease agreement to use an asset. Hold on, there is one check. But if no lock-in period, okay, I am coming to that question, Pratik. A lease agreement to use an asset is for 3 years. However, there is no lock-in period and lease can be terminated by either party with 15 days notice. What would be the lease term? See, there is no lock-in period. Though the lease agreement is for 3 years, there is no lock-in period. Lease can be terminated by either party within 15 days. What would be the lease term in this case? because the determination of lease term is very crucial because it involves straight lining of lease rental, as we have observed in the previous question. Even though the entity has spent only 1 lakh rupees, it had to, charge of 1.4 lakh rupees in the financial statements, just because of the concept of straight lining in the AS 19. So determination of lease term is very crucial. In this case, what would be the lease term? Anyone would like to try? Please, you can unmute or you can drop a probable answer in chat box. Okay, there is one response that has come from Pratik himself. Cancelable lease, so no straight line. Okay. Any other views? Fair argument, Pratik. Sunilji says actual lease paid needs to be recognized. Okay. Any other view, members? Okay, fine. Pratik and Sunilji, what AS 19 states that, okay, first of all, AS 19 does not contain any concept of lock-in period. This is the foremost thing that I wanted to highlight. There is no concept of lock-in period in AS 19. Second thing, AS 19 prescribes certain criteria for the lease to be qualified as a cancelable lease. There are 4 criteria that has been prescribed, and if one of those criteria is met, then only lease becomes cancelable lease. Mere existence of termination clause in the lease deed does not make the lease cancelable lease. Friend, these are not my views. These are the views of expert advisory committee. EAC had an occasion to deal with this issue and the same issue. And EAC has opined that since the lease has been contracted for a period of 3 years, mere existence of termination clause of 15 days does not in any way change the lease term. An entity needs to go to 4 criteria that have been prescribed in order to determine whether this lease qualifies to be a cancelable lease. Now let's see what are those criteria. According to me, the lease is for 3 years and straight lining would still apply. So as I said, there is no concept of lock-in period in AS 19. Mere existence of clause permitting termination of lease agreement upon notice does not by itself amount to a cancelable lease. Entire contractive period needs to be considered as lease term 3 years unless the lease is cancelable on account of factors mentioned in para 3.4 of the standards. What does para 3.4 states? The non-cancelable period is a period which is cancelable only. So if any of these 4 events occurs, then only the lease becomes cancelable, otherwise it is non-cancelable. So what are those 4 criteria? That the lease becomes cancelable only on the occurrence of some remote contingency. With the permission of a lessor, new lease with same or equivalent asset with same lessor, or it becomes cancelable only with the payment of additional amount clause, which makes lease period certain. So if any of these 4 criteria would be there, then only lease becomes cancelable. Otherwise, it would be safe to contend that the entire contracted period is the lease period. Hope I am clear. Okay, moving to AS22, accounting for taxes on income. An entity has history of losses and has significant amount of carry forward losses and unabsorbed depreciation. The entity does not recognize deferred tax asset on such losses due to lack of virtual certainty of their realization. However, deferred tax asset is being recognized on Section 43B disallowances and provision for doubtful debts, etc., based on reasonable certainty criteria. Is the recognition of DTA on such item appropriate? Sorry. Members would ponder upon these questions and come out with a probable solution. Please pardon me for 30 seconds. I'll be back. Yes, any member would like to try? So let's understand what are the requirements of AS22. What does AS22 state? That when there are timing differences, then the deferred tax asset on those timing differences can be recognized if there is a virtual certainty of its realization. If there is a reasonable certainty of its realization. And if there is carry forward losses and unobserved depreciation, DTA can be created if there is a virtual certainty of their realization. The two concepts are different. One is reasonable certainty, another is virtual certainty. So 43B disallowances and provision for doubtful debts are temporary differences, which can be recognized based on the reasonable certainty criteria. Okay, now when we carefully read the question, it states that the entity has history of losses and has significant amount of carry forward losses and unobserved depreciation. So even if there are 43B disallowances and provision for doubtful debts, that would again add back to my losses going forward on. Okay, so that would take the character of carry forward losses going forward. So whether entity can recognize these temporary differences based on reasonable certainty criteria, my answer would be absolutely no. The concept of prudence needs to be applied here. Though the standard says the reasonable criteria, certainty criteria needs to be considered for temporary differences, but we need to look at the substance of AS22 and we need to view the AS22 in a holistic manner. Further, AS26 intangible assets. An entity wants to recognize expenditure on an intangible asset that was recognized as an expense in the financial statements for 2020 as part of intangible assets in financial statements for the year 2021, whether it is permissible. So some of the expenses entity has recognized and charged off in the year 2020 itself. Now in the 2021, it wants to bring back those expenses and add it back those expenses in the cost of an asset in 2021, whether that is permissible under AS26. Please, member, do respond. Anyone? So basically, AS26 prohibits the recognition of an earlier charge of expense as an asset at a later date. So AS 26 clearly states that this is not permissible. Now, under which situation it can be permitted? It can still be permitted if the earlier recognition of an expense is treated as a prior period error. So if it is treated as a prior period error, an appropriate disclosure is made in the financial statement, it is still possible under AS 26 that these expenses can become a qualified expenses for the recognition and as an intangible asset. So the answer is clearly no, unless it is treated as prior period error. Okay. Entity has registered its own trademark and expects to use the same for 15 years. Can the same be amortized over a period of 15 years, or the amortization period needs to be restricted to 10 years? Again, I would request members to please participate. So the question is that company has registered its own trademark and expects to use this for 15 years. Okay. Now the amortization period, can the entity consider for 15 years, or amortization period needs to be restricted to 10 years? Pratik says yes, 15 years. Anyone would like to give it a try? Okay, so yes, agreed, Pratik. It can be, amortization period can be considered for 15 years, though AS 26 mentions that ordinarily the life of intangible asset should not exceed 10 years, but that is a rebuttable presumption. And if the entity can demonstrate with some form of concrete evidence that the life of an asset is 15 years and not 10 years, it can still consider 15 years. And it is not necessary that amortization period be restricted to 10 years only. Yes, amortization period can be considered for 15 years. An entity has developed in-house computer software and user can subscribe to access the software. An entity earns subscription income. An entity wants to revalue the carrying amount of said software considering the foregoing demand in the market. Can the entity revalue the software and bring the revalued figures on the books? So let's take an example. An entity has developed an in-house software. It gives the software rights on a subscription basis. And there is a tremendous demand for this subscription of this software. And the entity comes up to you as a consultant, as an auditor, and states that, look, the brand value of my software has gone up manifold. And I want to bring onto the books the fair value of my asset, intangible asset. Whether the entity is permissible to revalue the software and bring the fair value or revalued figures on the books. So the answer would be no, not permissible under AS 26, because this is a stark disconnect between the requirements of AS 10, property, plant, and equipment, and AS 26, intangible asset. AS 10 allows a subsequent measurement on a cost model or on a revaluation model, whereas AS 26 does not allow revaluation model for subsequent measurement and for initial measurement, of course. So for subsequent measurement of AS 20 for intangible asset, entity still needs to follow cost model. AS 28 impairment of assets, an entity has been making losses consistently since last 3 years. The carrying value of PPE is rupees 10 lakhs, whether the impairment testing is required. friends, let me tell you, this is the most neglected accounting standard, and many of the entities does not bother to comply with AS28. But in this COVID situation, these AS20 assumes a greater significance and importance as far as the auditor's responsibilities are concerned. So it becomes even more incumbent upon us rather than entity to see and check whether AS20 it has been complied in true letter and spirit. So there is an indication of impairment here because the entity has been making losses consistently since last 3 years. And of course, impairment testing is required. Whether impairment provision would emerge out of impairment testing, that is a different matter. But the asset should be tested for impairment. And if there is an impairment, that needs to be recognized. So what are the impairment? What are the factors that needs to be considered in order to arrive? What would be the value of the asset going forward? So the two concepts are there: value in use or net selling price. Value in use prescribes a certain discounted cash flow models, and net selling price prescribes what would be the fair value in the market to be considered while valuing the asset. So higher of two needs to be considered. If the value in use is higher, that needs to be considered, and if the net selling price is higher, that needs to be compared with the carrying value of an asset. Of course, this is not applicable to level 4 entities. A firm studio bought a high-tech digital camera system at a cost of rupees 5 crore on 1/4/20. On 31st March 21, introduction of a new and better version of the digital camera with lower operating cost had reduced both net selling price and the value in use of the camera. The carrying amount of the system is rupees 4.5 crores as at 2021. The value in use is determined to be 3.5 crores and net selling price is estimated at rupees 3 crores. Calculate the impairment loss. So friends, please let me know what would be the impairment loss, because the carrying value is 4.5, value in use 3.5, net selling price is 3. Can you let me know what would be the impairment loss in this case? Or whether at all there is an impairment loss? So of course there is an impairment loss here, but impairment loss would be the difference between the carrying amount, that is 4.5, and value in use, that is 3.5. So the impairment loss would be 1 crore rupees. Because value in use is higher than the net selling price in this case. And what the standard states, higher of two, higher of value in use or net selling price needs to be considered and compared with the carrying amount. So the impairment loss would be 1 crore rupees. Sir, how much time do I have?
Sir, you can continue.
Okay.
Yeah.
Continue, sir. We have up to 7 o'clock.
Oh, fair enough. Okay. AS 29, provisions, contingent liabilities, and contingent assets. So fire, earthquake has occurred and destroyed the entire factory after year end. Estimated loss to an entity is rupees 10 crores. Insurance claim receivable is rupees 6 crores. What are the implications? Please, members, do respond. What are the implications of this event? First of all, please let me know whether this is an adjusting event or non-adjusting event. Okay, Chandrali says this is non-adjusting event and note shall be given. Good, valid argument. Any other view? Sunilji, Prashantji, any view on this?
Sir, we can book a loss of rupees 4 crores.
Okay. So you are treating this as an adjusting event, right?
Yes, sir.
Pratik says since the entire factory is destroyed, this is adjusting event. Okay. Prashantji is also of the same view, Pratik.
I also, sir, with the same view.
Okay, fair enough. So let's understand what are the requirements of standard related to subsequent events and what are the requirements of AS29. Okay, there is one more answer from Mr. Jain. Non-adjusting event loss to be claimed 4 crores and amount receivable 6 crores. Okay, valid argument. So, fire, earthquake is obviously a non-adjusting event because it has occurred subsequent to year end. So there was no condition existing on the balance sheet date which would warrant recognition of this loss in the financial statements. That is one rationale for treating this event as a non-adjusting event. Now, what are the implications? Now, see, for mid-size entities or smaller size entities, these 4 crore loss, estimated loss is 10 crores, insurance claim receivable is 6 crores. 4 crore loss is a huge loss. And as an auditor, we need to ask to an entity whether the going concern assumption is still appropriate for the preparation of the financial statements. Entity might come up and say, so we are lost, भाई साहब हम तो खत्म हो गए, बर्बाद हो गए, ठीक है? We cannot absorb these 4 crore loss at all. So in that case, going concern assumption would not be appropriate. And if the going concern assumption is not appropriate, then this becomes an adjusting event. This entire fire earthquake, though non-adjusting event in normal circumstances, would become an adjusting event when the going concern assumption is jeopardized. Hope I am clear on this. Non-adjusting event, however, auditor needs to inquire whether the going concern assumption is still appropriate. If not appropriate, this would become adjusting event. Okay. Whether the contingent liability needs to be disclosed by an entity following cash system of accounting. Yes, Parasji, going concern disclosure has to be there. I agree with you. Okay, whether moving to next question, whether the contingent liabilities need to be disclosed by an entity following cash system of accounting. Normally, we do not disclose the contingent liabilities for an entity following cash system of accounting.
But sir, this is a special event, na? Like
which one?
This one is a big loss.
Yes.
Like you said right now.
Yes.
So for determining, for bringing the fair position in front of the investors, it is indeed necessary to disclose even if following the cash system.
The disclosure can be given, Prashantji, but
yes,
we need to see, no matter how bad the loss is, we need to see whether the condition was existing on the balance sheet date. That we need to factor into. When there is no this is not like some receivables which has a deteriorated financial position as of 31st March 21, and that has been confirmed subsequent to year end date. Okay, so here this is a absolutely new development. Fire, earthquake, no one would have predicted. This is absolutely new development, and this condition was not existing. So this becomes a non-adjusting event. And if the entity is able to bear that loss, a mere disclosure would suffice. And if the entity is not able to bear this loss, then the going concern assumption would be jeopardized. And in that event only, this would become adjusting event. Hope I am clear. Okay. Moving to next question, whether the contingent liability need to be disclosed by an entity following cash system of accounting. Pratik says yes, they should. Other views on this? Okay. Normally, even the incurred obligations are not recognized in the financial statements of an entity following cash system of accounting. Say, for example, the entity has availed services of around rupees 10 lakh rupees, and entity has consumed those services and earned revenue out of it. But those services have not been paid yet. Okay, so there is an incurred obligation. 10 lakh rupees actually services have been availed by an entity. Still, the provision has not been made in the financial statement. This is an incurred obligation. So, if the incurred obligation is not recognized in the financial statement, whether any disclosure of the contingent liability would be warranted. My answer would be no, the contingent liability need not be disclosed. Of course, this is a matter of interpretation, but if the contingent liability someone says it needs to be disclosed, then other incurred obligations should also be disclosed. Like, for example, I have narrated the services have been consumed. That also needs to be disclosed as incurred obligation along with the contingent liability. The answer would be no. Okay. A retail store has a policy of refunding purchases by dissatisfied customers. Many of the provision stores or many of the retail stores have the policy whenever you go that they normally give us a refund. Okay, they has a policy of refunding purchases by dissatisfied customer, even though it is under no legal obligation to do so. There is no binding legal obligations on an entity. Okay, its policy of making refunds is generally well known. Whether the provision is required to be made in books of accounts for probable refunds, even though there does not exist legal obligation. Members, what are your views? So, okay, obligation can arise from the customary practices followed by the store or by an entity. So if it has been consistently following a practice of refunding the amount for the defective purchases, then though the legal obligation is not there, the provision for probable refunds need to be recognized in the books of accounts. That's what AS 29 prescribes. Yes, obligations also arise from the normal business practice, custom, and desire to maintain good business relations or act in an equitable manner. So provision needs to be recognized. Next issue, an entity took a factory premise on non-cancelable lease on 1/4/20. The lease is operating lease and is for a period of 4 years. During March 21, entity relocates its operations to a new factory building. The lease on the old factory premises continues to be live. The lease cannot be cancelled and cannot be sublet to other users. It also doesn't have alternative use. The auditor insists that lease rent for balance 3 years should be provided in the accounts for the year ended 2021. An entity seeks your advice. What would be your advice in this situation? Say there is a non-cancelable lease. It cannot be cancelled and it doesn't have any alternative use. And lease is for a period of 4 years. Now you relocate to some other factory building and that empty premises doesn't have any alternative use or you cannot even sublet. An auditor insists that this rent of balance 3 period should be provided upfront in the accounts for the year 2021. So, as a consultant of an auditor of an entity, what would be your advice? Please respond, friends. Okay. See, there is a concept. Okay, there is one answer that has come. Mr. Jain says obligation exists and certain is non-cancelable. Fair enough. I agree with you, Mr. Jain. There is a concept of onerous contracts in AS 29. Okay. Now, what is onerous contract? The onerous contract is a contract where the unavoidable cost of fulfilling those contracts exceeds the economic benefits that are to be derived out of use of that asset. In nutshell, onerous contract is not cancelable, and whenever onerous contract gets triggered, then the provision of the involved amount needs to be made upfront in the books. Since this is a non-cancelable lease, these leased premises does not have alternative use, and the entities does not have any other option but to assume that obligation. This being an onerous contract, that provision needs to be provided for 3 years upfront in the books of account. If the entity can negotiate with the lessor to sublet these premises to another user, then this entire gamut of the scenario changes and the whole accounting treatment would change in that perspective. So binding an onerous contract provision needs to be made for unavoidable cost. Okay. When contingent liability needs to be disclosed with respect to LC given for import purchases, when no supplies are yet made at reporting date, supplies are made at reporting date, and as per Incoterms, risk and rewards are transferred. And in the subsequent issue, as per Incoterms, no risk and rewards are transferred to the entity. So here is the question: what could be whether the contingent liability LC obligation needs to be treated as a contingent liability or not? So friends, I would deal with this issue from two angles. I would see whether and how my primary transaction would be recognized. So LC for purchase has been obtained. So whenever I make a purchase against that LC, I would naturally be recognizing those purchases and recognizing provision for creditors in my books. So if I'm recognizing provision for my creditors, there is no question of disclosing LC facility as a contingent liability, number one thing. Number two thing is, what is my obligating event here in order to recognize contingent liability? Since I have recognized the obligation itself in the books of accounts, I do not have any other obligation to disclose LC as my contingent liability. Okay. Now take a second situation. If I have availed the LC for the benefit of the third party, say for example, I have a spare LC facility available with my bankers, and one of my related party comes and requests to me that you have an unused LC facility. Why don't you, allow me to use that facility, and you become a LC facilitator? In this case, if I request my bankers, okay, you open the LC for the benefit of my related party, I am still responsible for the default that might be that might occur from the mischiefs of the third party. So in that case, if the LC facility I have availed for the benefit of the third party, that would be required to be disclosed and as a contingent liability. Okay, fine. So friends, we have come to a last question, which is very much pertinent, which talks about all the provisions. So which accounting standard would apply to following provisions? Provisions for contingencies against pending litigations. There are some litigations going on, and company, out of the abundant conservatism, has made a certain provisions, and titled as a provision for contingencies. Another is impairment provision against CWIP, capital work in progress, not PP, property, plant and equipment is not. Provision for doubtful debts, and provision for dismantling, decommissioning liabilities. Everything, all the issues talks about the provisions. Now, which accounting standard would apply to these provisions? Okay, let's take issue by issue. First one, provision for contingencies against pending litigations. Which accounting standard would apply here? Anyone? Okay, the answer would be AS29. Okay, someone has responded. Parasji said AS1. AS1, Parasji, talks about disclosure of accounting policy. It doesn't talk about recognition of provision under particular standard. Okay. Impairment provision against CWIP. We all know that PP, if any impairment arises on PP, it would be recognized under AS28, impairment of assets. What about CWIP? It has not taken a character of PP yet. It is still capital work in progress. Impairment provision against CWIP would still be recognized under AS28, it being a capital in nature. Okay, and the entire CWIP disclosure is also forming part under the non-current assets or non-current assets, yes. Provision for doubtful debts. Which standard would apply here? AS29, AS28, AS9, revenue recognition. The answer would be AS4 would apply. AS4 would apply. I will come in a minute why AS4 and why AS29, but here in this case, AS4 would apply. Okay, provisions for dismantling, decommissioning liability. Which standard would apply here? AS29, AS4, AS28. Okay, let me give you answer. Two standards would apply here. AS29 would also apply and AS10 would also apply. The measurement of the provision would be required under AS29 on the best estimate basis. So the provision would be measured based on the principles given under AS29, and whatever provision amount is arrived or determined, that would be capitalized under AS10 in the cost of the PPE. So AS10 and AS29 both would apply here. So friends, if you have noticed, all the issues talked about provisions, but the different standards would apply to the different provisions. Now let me come to the provision for doubtful dates and why AS4 applies and why AS29 does not apply. Okay, so basically, friends, AS29 came into picture in 2004. Before that, AS4 was in operation or was in force. With the introduction of AS29, what the institute has done, that whatever contingencies those are being dealt with AS29, these have been removed from AS4 and they have become part of AS29. So AS4 practically is restricted to the impairment provisions related to the financial assets only. Financial assets meaning the receivables, trade receivables, other receivables. So impairment provisions related to financial assets would be governed by AS4 and other provisions would be governed by the respective standards. Hope I am clear on this front. So thank you very much, friends, for patient listening. Hope I have been able to cover many of the issues which we encountered while dealing with the entities accounts. Thank you so much.
Thank you, sir. Thank you, Shripal sir. You have explained the subject accounting standard in a very simple manner and very interesting way in the format of a question and answer, so that the members have taken interactive part in it. And you have explained it in a very simple and easy manner. Now I will request CA. Now I will request CA Vipul Patel, Secretary and immediate past chairman of Aravati branch, to
Thank you.
give the vote of thanks to Shripal sir. Thank you.
Thank you, Prashant Agrawal ji, Chairman Jalgaon branch. Prashant ji, you have rightly said that Shripal sir has given a full justice to our today's session on accounting standards, especially applicable to non-company entities. Sir's session was entirely through the question and answer mode, which enable our members to engage the session throughout the session. Thank you so much, sir, for quite an interactive, unique session. I'm sure this session will be very useful and informative session for all our members. Though,
you,
sir, a lot of, yes, sir, though a lot of questions were bouncing for all of us. Yeah.
I hope I have tried to do justice to the questions and the probable answers.
Yes, sir. But though a lot of your questions are for all of us, but I'm sure, sir, these 12 questions are very much relevant and informative and useful while finalizing the financial statement, especially for the non-corporate entities. These sessions are highlighted and tells us that how much important the role of accounting standard in finalizing any financial statement. Thank you so much, sir. Initially, we have planned session for 2 hours. It has been extended up to 3 hours. It's almost 7 p.m. right now, and members are still with us. So, कितना useful session है, sir, ये आपको ये पता ही चल सकता है. I am also equally thankful to our both the special guests, CA Chintan Patel sir and CA Vishal Doshi sir, who have highlighted and guided us about the various initiatives taken on particular this subject at WRC level. I'm sure this information and our today's session will be very, very useful to all our members. And last but not the least, I am also thankful to all our members who have joined us through virtual mode. And I'm sure this deliberation will help us in the future. Thank you so much. Now, I think with the permission of both the chairmen, we can conclude our today's session.
Thank you.
Yes. Thank you, Vipul.
Thank you, sir.
Thank you, Shripal sir.
Thank you, sir.
Thank you so
Thank
much.
you, Divya.
Thank you very much.
Yes.
Thank you.
Thank you, sir.
Thank you.
Thank you, sir.
Can I end the meeting?
Yes. You can end it.
Cara di video, ikannya banyak. Video, no sale. Ada kita
चला चला. Yeah. Oh. 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 Yeah. सकाळी तर झालंच असेल. हो. अजून पण जेवण
अनु अनु तो वाईट पहिले पाणी ठेवून काढ ठेव
वर वर जायचं ना आंघोळीला
पहिले पाणी काय बोलतो माझं घ्या हा अनु तारा कमाते हैं हम्म. काय टेंबूळ म्हणजे फोटो फोन नाही लोक